Okay, so hello students, how are you all doing? I'm sure you all are doing wonderful. Students, finally, we are headed to monetary policy. That is unit 3 for our foundation curriculum. Okay, I'll re I'll request every student to go through the certain points, right? Number one, students, number one is ICI material is the most important material. So after we complete every unit, I hope so that all of you are revising the same at least 2 times because it takes time to remember things. Okay. Number one. So let's start with unit 3 of chapter number 8 class. That is monetary policy. Okay. Students, in the last part of chapter 8, unit 2, if you remember, I had already introduced this concept. I will recap that for you so that everybody who wants to you see unit 3, understand unit 3 can do so. What is monetary policy? It is the use of actions. Monetary policy refers to the actions. Who takes those actions? By RBI. On whose behalf are these actions taken? You are right, the government of India. So monetary policy refers to actions taken by RBI to control supply of money, cost of money, and availability of credit. Three things to be controlled: supply of money, cost of money, and availability of credit. What is the reason, sir? Actually, there are many reasons to monetary policy. Prime two are economic growth and stability. It means stability means what, sir? That there is no excessive inflation or there is no depression. See, some inflation or some recession might happen. That is, useless. That doesn't need any action. So it is the action taken by RBI to control supply of money, cost of money, and availability of credit. Students, I hope you have noted this down or you have summarized it. I had told you all when I'm teaching, try to make it a habit of noting down. All the handwritten notes are going to be really useful. Done? And that's why I'm waiting. Okay. Students, monetary policy we have understood. Now, students, there are two languages that deserve understanding: expansionary policy and contractionary policy. Okay. See, expansionary policy is the one, dear students, where the goal is to increase money supply. Expansionary policy, the goal is to increase money supply, which means to increase the availability of credit. To increase the availability of credit. That money is easily available. To increase money supply, that is the availability of credit. While the contractionary policy tells us what, class? Contractionary policy tells us to reduce money supply, to reduce money supply. That is to reduce the availability of credit. Okay. But sir, why will the government want to change the money supply? What good it brings? I'll tell you. To understand the medicine, you have to understand the disease. To understand the medicine, you have to understand the disease. Now let me tell you, let's say a doctor is prescribing antibiotic, right? Why is he prescribing antibiotic? Because you have bad bacteria. Bad bacteria causes infection. What does antibiotic do? Kills the bacteria. So the medicine was made keeping in mind the problem that arose. What was the problem? Growth of bad bacteria. What is the solution? Kill the bacteria. ठीक है sir. Let me put it to context. You will say, sir, ये क्या बोल दिया आपने? Now let me bring the context for you here. Here is the context, class. Here is the context. Inflation. Try to understand the disease now. Why does inflation arise? There could be multiple reasons. I am talking about one particular symptom. See, students, inflation, in inflation, the symptom is prices are rising. Prices are rising. Why is this symptom showing up? Let's try to understand the symptom. The thing is that in economy, there is huge money supply. In economy, there is huge money supply. In economy, there is huge money supply. So since in economy, everybody has money, there is huge money supply. Since in economy, everybody has money, pay attention everyone. In economy, everybody has money. That is, there is huge money supply. So since there is huge money supply, people have high purchasing power. People have high purchasing power. High purchasing power. Why people have high purchasing power? Because of high money supply. So high purchasing power leads to what? High demand. Dears, what does high purchasing power lead to? High demand. High demand. When students, there is high demand. When students, there is high demand. But supply is limited. High demand, but supply is limited. High demand, but supply is limited. Are you understanding? Demand is high, but supply is limited. So prices rise. So price rises. So prices rise. Because see, everybody is wanting the same commodity. Let's see this pen. Everybody is wanting this pen. But supply is limited only. So the price of this pen rises. You see, uh, in a day or two, right? In a day or two, say for example, you witness that suppose in a day or two, suppose there is a huge FIFA World Cup game, finals. Suppose there is a huge FIFA World Cup game, it's the finals. Example between two countries, let's say Spain and Argentina. Spain versus Argentina. Now everybody wants to visit this match and witness the game in the stadium. Witness the game in the stadium. The stadium has a capacity of 1 lakh people. And the viewers of football across the globe, I may be understating the numbers, I haven't researched it. So just for my, assumption, I could say that because the entire world watches football, I could say 180 crores. Easily, 180 crores would be easy number. If any of you would have researched, just let me know. Whatever. Suppose 180 crore people watch football. 180 crores people will be witnessing this event. And you see how many are present at the event? 1 lakh. Out of this 180 crores, you will agree at least 5 crore will be able to visit to the country, let's say USA or whatever place, and witness this game. They will be able to afford to. But how many are able to finally reach the stadium? 1 lakh. Are you getting my point? Are you getting my point? Yes, sir. We do understand. So the price of the tickets will rise because 5 crore people are bidding for it. Inflation. Everybody has money. Obviously, FIFA World Cup is just one game. Rise in its price cannot be considered as inflation. But what I'm trying to tell you is think of this in the entire economic perspective. For every commodity, demand is rising. But for every commodity like this FIFA World Cup tickets, the supply is limited. So their prices are rising. What was the main culprit? What was the main cause of the disease? Huge money supply. So what is the medicine? Reduce money supply. So during inflation, contractionary policies pursued. Contractionary policies pursued for that disease. Contractionary policy. So during inflation, what kind of policy is pursued? If ICAI asks you, students, you know the answer now. Contractionary monetary policy. Now let me take the question or explain you the entire question in a different context altogether. Okay. Let me take you to the opposite, to the opposite, to the opposite. Suppose economy is witnessing recession. What is recession? What is recession? Fall in prices. What is recession? Fall in prices. Now, why does recession occur? Why does recession occur? Recession is fall in prices. But why does it occur? Due to reduced money supply. Reduced money supply. So, sir, when the money supply is less, when the money supply is less, when the money supply is less, people have low buying power. Low buying power, dear students, transcends to low demand, transcends to low demand. Demand is low, but still the supply is high. But still the supply is high. Demand is low, but the supply is high. I'll give you an example. COVID, there was lower demand for hotels. There was lower demand for tours and travels. There was lower demand for cafes. There was lower demand for cinema. But their supply was still high. So what happens then? So what happens then? During low demand, what happens then? During low demand, there is high supply. So what happens, everyone? People, interesting, pay attention, pay attention. People have purchasing power. People have purchasing power that is low. And low purchasing power means low demand. Low demand means businesses shut down and prices fall. Businesses shut down and prices fall. BHD, businesses shut down plus prices fall. This is the symptom and the cause. Medicine. Students, the symptom was reduced money supply. What is the medicine that you are going to administer? Expansionary policy. Write down expansionary policy. So during recession, what do we follow? We follow expansionary policy. Please note it down, class. During recession, my dear students, what policy do we follow? We follow expansionary policy. So instead of reducing money supply, we increase money supply. So impact of recession is cut down. So impact of recession is cut down. That is the entire picture. Right. So students always remember during recession, the government is going to pursue expansionary policy, and during inflation, the government is going to pursue contractionary policy. During inflation, reduce money supply. During recession, increase money supply. How to do that? I will talk about that later. Other questions, everything will be clear. Okay. So see, what is written here? Acha, one more thing. Institute knows that you know about expansion. They will use the word easy money. Easy money policy means expanding credit. Sir, so why is it called easy money? Because, dear students, money will be available easily at good credit terms. Good credit terms. Do you want to know the example of expansionary policy? I can give you an example. I remember. Acha, when is expansionary policy pursued? I hope every friend now remembers it. During recession, you know this, right? Now, dear students, your answer. Now, your answer. Why it's the easy money policy and so on and so forth. Pay attention, class. Why so? The example is during COVID, students, you know, during COVID time, I was able to purchase my first smart television. Earlier, before 2020, you will be surprised. In my house, there was a television from 1995, 25 years. It was the old cathode ray tube type television, CRT type television, not that thin screen. Sir, but why did you buy it during this recession time, during this COVID time? As I remember, the television was worth rupees 20,000. Good thing was I wanted it on EMI. I wanted it on EMI. They just divided it by 10. So I had to pay 2,000 per month. No interest, nothing. Now you go and buy a 20,000 television. They will say no EMI, no cost EMI, etc., etc. Ultimately, for a 20,000 television, you will surely end up paying 23,000, around that amount. They will say, okay, I will give you an example. This is 2000, around this is 26, 27 time, right? Year 26, 27 we are in. A recent example I will give you. So I needed to buy an air conditioner, okay? So the price of that air conditioner, as I remember, was around 40,000. I don't remember the exact figure. 40,000. Again, I said, Bhaiya, give it in installments. So what they said, okay, 10 months. I was happy. The times have not changed. Everything is same. So 4,000 per month. They say, yes, sir, you have to pay 4,000 per month up to 10 months. And just 3,000 is a convenience charge. I said, it is convenience to you, inconvenience to me. Why will I give you convenience charge? For you, I won't give you any charge. I did not buy that AC. Instead, I bought it from somewhere else, paying the entire amount. So you see, I was able to buy the same thing during COVID because it was easy credit then. But during 2020, everybody got this habit of no cost EMI. Now the companies are not able to charge interest only. So what they are doing, they are collecting upfront some commission. That is the habit they are pursuing. Understood, friends? So that is the expansionary policy that I explained, right? So it is used during recession, where what is done? RBI reduces interest rate, so money supply increases. What are its effects? Class, what are its effects? Loans become cheaper. I gave you the example, practical example right now. EMI is also a loan. Getting a product on EMI is also a loan. It became cheaper. It became cheaper. When loans become cheap, when loans become cheap, when loans become cheap, investment increases. Class, when loans become cheap, investment increases. And when investment increases, employment also increases. Why? Why? Because when loans have become cheaper, I will be in a position to borrow from the bank and take a risk कि चलो business करके देखते हैं. Let's try and pursue a business opportunity. And when I invest in the economy, dear students, you got to pay attention. Obviously, the employment will be generated. When I am able to take loans from a bank at low rate of interest, friends, naturally, I will be able to invest. When I am investing, I am employing people. Na? I am giving people work. Sir, absolutely logical. So in monetary policy, number one, I explained expansionary policy. Now number two is contractionary policy. Students, what is contractionary policy? It is also a tight money policy. Tight money policy? Sir, what is this tight money policy? Let me clear it out. Students, it is used during inflation. It is used when? During inflation. What happens here is, during inflation, what happens here is RBI increases interest rates. RBI increases interest rates. So interest rate increases on loans. Interest rate increases on loan. Okay. Interest rate increases on loan. When interest rate has increased, loans have become expensive, friends. Friends, when loans have become expensive, money supply falls. Why? Because people are not willing to take money now. So inflation is controlled. Because during inflation, we want demand of the people to fall. You want demand of the people to fall. Okay. So now we move to objectives of monetary policy. Students, I hope everything is clear so far. Anything not noted, please do it. This is for your handwritten notes, okay? For the last minute revision. Everybody has noted it down apparently. Now, friends, objectives of monetary policy. First is primary objective, and then there are other or secondary objectives. Primary objective, I have already told you all. What is the primary objective of monetary policy? Price stability, just a moment. Price stability and economic growth. Price stability and economic growth. So these are the two main objectives of monetary policy. What is price stability? To avoid unnecessary fluctuations in prices. What is price stability? Avoid unnecessary fluctuation in prices. Avoid unnecessary price fluctuation. To avoid unnecessary price fluctuation. And along with this, students, to achieve economic growth. Sir, what is economic growth? Most of you don't know this. Economic growth, you can write it down, class. I will wait for 1 minute. Rise in per capita income. That is average income. In national income, you have heard per capita income. So it is nothing, dear students, but rise in per capita income. Okay. Please note it before I speak further. It's rise in per capita income. Now, There are other objectives also. It is to ensure adequate credit flows to productive sectors. Now, sir, what is productive sectors? What is productive sector and what is this unproductive sector, sir? Students try to understand. Productive sector is the one where if you invest, I mean, if the government grants money, they are going to bring in more taxes and money in the economy. Sir, can you explain us with an example? Sure, sure. Agricultural sector. If the government sets up or provides easy credit to the agricultural sector, they are going to bring money into the economy. As agricultural sector will get money, they are going to invest in us. They are going to invest in the business, agricultural sector business, and therefore output will bring India money because India will be able to export agricultural output, not only for consumption in India, but also outside. Moderate interest rates are ensured. Financial markets, that is the stock market develops, and exchange rate, that is dollar to rupee or other currencies, remains relatively stable. So there is always the goal of maintaining stability and growth balance. Okay, class. So far, whatever I have done, now let's sum it up. Just a minute now, class. Just a minute, class. Yes. Whatever we have done so far, let's sum it up. अभी तक जो भी पढ़े हम लोग, see, I have taught you monetary policy refers to the use of instruments, monetary policy instruments. By who? By the central bank, that is the RBI. By the RBI to regulate the availability, cost and use of money and credit, to promote economic growth, stability, optimum level of output and employment, balance of payments equilibrium, stable currency, or any other goal of government's economic policy, or any other goal of government's economic policy. There are different objectives of monetary policy. Number one is maintenance of price stability. Maintenance of price stability means controlling inflation. Number two is achievement of economic growth. Full employment, BOP stability, financial stability, stable currency, adequate flow of credit to productive sectors, moderate interest rates, development of efficient market for GSEC, government securities. Government securities are basically government bonds that RBI issues so that the government can borrow. Now, students, we will move to monetary policy framework. We will move to what? Monetary policy framework. In monetary policy framework, students, there are three basic components. Objectives of monetary policy, analytics, that is the transmission mechanism, and the operating procedure. I will come to it one by one from my detailed notes. Let's go. Let's go. Monetary policy framework. First of all, monetary policy transmission. So here we are going to study how RBI's decision affects the economy. So what you will see is a two-step process. RBI is going to change its interest rate. That is, it is going to increase or reduce the interest rate. यही दोनों हो सकता है, दोनों यही हो सकता है. Only these two are possible. So RBI is going to increase or reduce the interest rate. And when it increases or reduces the interest rate, it affects investment, it affects consumption, and it affects inflation. Three things it will affect: investment, consumption, and inflation. How are these channelized? Here we go. You will understand this. Number one is, dear students, savings and investment channel. Number one is savings and investment channel. Savings and investment channel. A very simple mechanics, a very simple thing. If interest rate is increased, if interest rate is increased by RBI, what will people do? See, interest rate increase means two things. One is for the households, right, who are saving, and one is for the businesses. If interest rate is increased, households will put their money in the banks. Why? Everybody wants to earn high interest. But interest rate increase for businesses means loans have become expensive. Loans have become expensive. So friends, when loans have become expensive, naturally the investment is going to go down because the loans have become expensive. Class, when the loans have become expensive, investment goes down. Naturally, employment goes down. Hence you see, hence you see a recession-like condition starting to form. Whether it fully transcends to recession is not a guarantee, but a situation like this has already started to form. Here it is. And to the contrary, I explained you the opposite example. Now let me explain the notes example. So friends, if interest rate is reduced, always remember, reduction of interest rate has two meanings for two different people. For household, it means that if they are putting their money in the bank, if they are putting their money in the bank, they are earning less. They are earning less. This is the meaning for who? This is the meaning for the household. Interest rate reduces, and friends, when interest rate reduces, the borrowings increase. You know why? Because it's good news for the firms. For household, it's bad news. Why? Because now, even if I put my money in the bank, I will not earn much, maybe 2.7 to 3%. Is it very attractive? I don't think so. Is it attractive? No. But for businesses, it's good news. They will increase their borrowings. And if the businesses borrow more, investment increases and the growth takes place and economy grows. Sir, we did understand this. We did understand this. Next. Next is class cash flow channel. Cash flow channel. What does this channel say? Class, if interest rate goes down, if interest rate goes down, think carefully. Cash flow will improve. You know why? If interest rates have reduced, the EMI that I am paying, that will effectively reduce. Friends, in practical world, what happens? I will tell you. Suppose you have a home loan. Okay, suppose you have a home loan and banks have reduced the interest rates. So friends, what happens in real life? Do you know? When banks reduce the interest rates, na, your EMI does not get reduced. Suppose the EMI was for 20 years. Banks are going to charge lesser interest from you. The extra portion in the EMI that you are paying na, will result in your loan getting over before 20 years. So your loan will possibly get over in 17 or 18 years, maybe. That's what happens. Whatever it is, because of this, your disposable income rises. Friends, Because of this, your disposable income rises. And since your disposable income rises, your spending also rises. Because when your suppose students, one friend of ours is paying 35,000 EMI per month for a house he or she has purchased. Okay. Earlier, the breakup was something like 25,000 was the principal component, 10,000 was the interest component. Now, with reduction in interest rates, 35,000 is the amount still. But now 28,000 is the principal and 7,000 is the interest. Can you see the loan is getting over quickly? The principal portion of the loan is now more. That's good news or bad news? Good news. So this household will be left with more income because lesser interest they have charged. Acha students, you may be wondering, is it really that serious? I will give you a number. For a 35 lakh income, for a 35 lakh loan. Okay, for a 35 lakh loan, just for example, say taken at 8%, say taken at 8% for 20 years, maybe. Do you have idea of the total interest paid by the consumer in these 20 years? 38 lakhs. So on a loan of 35 lakhs, you are paying 38 lakhs of interest over the course of 20 years. So even pay attention, even a 0.2% reduction in interest rate means instead of 38 lakhs, you are paying 33 lakhs or 34 lakhs. Now do you feel the real heat? Yes, sir, understood. So it really does matter. You are thinking 0.2% ही कम हुआ. No, it means instead of 38 lakh, you are paying 33 lakh. Your disposable income is more by 5 lakhs. What are you joking? So understood, sir. Understood, sir. Now class, we have what channel? Asset price channel. We have what channel? Asset price channel. I will explain this again. You are seeing, na? We have understood two channels of monetary policy transmission already. One was in the course of savings and investments. Second was in the course of cash flows. In the course of cash flows. Third one, let's go. Asset price channel. That's an interesting one. What does asset price channel tell us? What does it tell us? Think carefully. Interest rate falls. Again, interest rate fall means loans have become cheaper. Interest rate falls means what? Loans have become cheaper. So loans taken by people increases. Let's say when the loans have become cheaper, people are saying that, okay, we are going to buy our own flat or our own car. Let's say people are saying, हम अपना flat खरीदेंगे या अपना घर खरीदेंगे. Let's say people are saying that. So loans have increased. When, when loans have increased, interest rate fell. So the loans have increased. When the loans have increased, when the loans have increased, that is the loans granted by the people that have increased, the demand for houses increase. Now you tell me, demand for houses have increased. Demand may have increased. Demand for houses may have increased. Demand for houses may have increased, but, but, pay attention, class. There might be increase in demand for houses, but houses are limited. So when houses are limited, the price of the house will, what will happen to the price of house? Increase, because they are in limited supply. When the price of house increases, just tell me one thing. House is a wealth of a person. Wealth of a person increases. So when they mortgage it, they will be able to take more loans out of it. Understood or not? They would be able to take more loans. And you see, what was the cause? More loans. What is the impact? More loans. This is how the cycle works. You can copy it. This is more complicated. You can copy this simple one. हाँ. हो गया? Let's go, class. हाँ. Now everyone, this is asset price channel. Now what is it, class? Exchange rate channel. Interesting, nahi? Let's see. Let's explain. When interest rate has reduced, class, think carefully, friends. When interest rates have reduced, loans have become cheap. But who is angry now? The foreign investor who had invested in Indian securities. Why? They are earning less interest. Why would they want to earn less interest on their money? What will the foreign investor do? They will leave. They will leave. So when the foreign investors leave, the rupee falls, because they will want to buy for dollars. They will want more dollars, because now they will invest in foreign markets, not in India. So they are leaving. Rupee has fallen. Class, when rupee has fallen, exports will increase. Exports will increase. You know why? Because rupee has fallen. So Indian goods have become cheaper. And that's how it works. Exchange rate channel. So class, how many types of channels have we studied, class? Channels we have studied, class. Four types of channel we have studied, class. Now, let me give you a golden line for your exam. Transmission mechanism explains how monetary policy affects output and inflation. Agreed. We studied right now, na, what will happen to the output in the country, what will happen to inflation. We studied that. Now, monetary policy tools, students, they are of two types. Okay, quantitative and qualitative. There are quantitative tools as well as there are qualitative tools. Okay, quantitative tools, and then there are qualitative tools. Are we ready, class? Are we ready? So, number one tool is CRR, cash reserve ratio. CRR. That is what, class? Cash reserve ratio. Let me explain. This is RBI. Suppose RBI looks after different commercial banks. One commercial bank has 1,000 rupees of deposits. What does commercial bank do? Commercial banks use this 1,000 rupee to give loans to some people, or else how will the banks earn money? Now what does RBI do? RBI steps in. RBI steps in. RBI steps in, class. And what does RBI do? What does RBI do? It steps in. Okay. RBI steps in. And see, this is the loan. This is the loan. Now what does RBI do? It basically, okay, it basically tells the commercial bank that, okay, you cannot give the entire amount as loan. Let's say RBI keeps the cash reserve ratio as 20%. It means out of 1,000 rupees that commercial banks have, 200 rupees they have to keep with RBI. 200 they have to keep with RBI. No option. Yes. Remaining 800 can be used to generate loans. Remaining 800 can be used to generate loans. So during inflation, there is a need to reduce money supply. During inflation, friends, there is a need to reduce money supply. Correct? RBI increases the CRR. During inflation, there is a need to reduce money supply. So RBI increases the CRR. Right? And when during recession, there is a need to increase money supply, RBI reduces the CRR. In fact, I will tell you one thing. I will tell you one thing. In quantitative techniques, I will be explaining various types of rates. Okay? Cash reserve ratio is just the first one. Remember one thing. Any rate that you will study today in quantitative techniques, any rate or qualitative technique, any rate during inflation, any rate is increased, any rate. And during recession, they are reduced. During recession, they are reduced. That's the technique number one. Now, SLR, again another rate or ratio. Statutory liquidity ratio. Students, much like cash reserve ratio, statutory liquidity ratio also represents a percentage of total deposits. A percentage of total deposits of RBI, a percentage of total deposits of commercial banks that they have to keep with RBI, or they can keep it with themselves. But the key thing is, in CRR class, cash reserve ratio has to be maintained in the form of cash. In case of SLR students, it can be maintained in the form of gold and other securities. The main rule remains the same, that during inflation, SLR is increased During recession, SLR is decreased. This prime formula, prime rule won't and will not change. Will not change. So this is SLR. This is the money that people are keeping in liquid assets like gold and securities. Like gold and securities. Now, open market operations. Open market operations. Open market operations. RBI buys or sells government securities in the open market. RBI buys or sells government securities in the open market. But what happens here, I will explain. Suppose we are seeing inflation. During inflation, there is a need to increase money supply or reduce money supply. Reduce money supply. Now open market operations will be interesting to you. What will RBI do? RBI will step in. You can download this website app, RBI Retail Direct. I had told in the earlier classes as well. Retail Direct. If you all want to buy securities of the government, RBI Retail Direct is an app. Now, students, RBI Retail Direct, what it does is it sells government securities at attractive rate of interest. Say 10% per annum. Oh my God. Who gives 10% per annum? Now the public feel, oh my God, such a high rate of interest offered by RBI. In any country, the most secured can be RBI. Okay, let's buy this. Remember, these bonds cannot be purchased for 500 or 1000 rupees. Minimum sum has to be paid. Say 2 lakhs. Say 5 lakhs. When you buy a 2 lakh or a 5 lakh bond, naturally what has happened? What has happened? The money in the economy, the money available with the people in the economy reduces. That was the goal, to reduce money with the people. And when in recession there is a need to increase money supply, RBI returns that money to the people so that people are able to use that returned money to spend in the economy. So people are able to use that money to spend in the economy. Wow. Fantastic, sir. Got it, sir. Still, quantitative techniques is continuing. Still, quantitative techniques is continuing. As I remember, I have explained three of them, isn't it? Cash reserve ratio, statutory liquidity ratio, and open market operations, OMO. CRR, SLR, and OMO. Now, class, let's look at the next one. What is it, class? Repo. What is repo? Students, it is the rate at which RBI lends money to banks. Rate at which RBI lends money to banks. Sir, so what is interesting here? Students, it is the rate at which RBI lends to banks for short term. You should remember. Repo rate is for short term. So now what happens is, suppose, okay, suppose Yes. For example, commercial banks get their money from RBI. Now, for some short period, commercial banks need a loan. Why do commercial banks need a loan? Because they need to give the loan to public. If RBI is giving loans to commercial bank at 5%, maybe commercial banks are going to charge the public 9%. But if RBI increases the rate of loan to 8%, commercial banks will give the same loan to public at 13%. Now look, think from public's perspective. Is this 13% huge or small? 13% is huge. Class, this 13% is not small. This 13% is huge. Huge. So when this 13% is huge, class, now, when this 13% is huge, what happens? What happens? People will get less interested in taking the loan and therefore money supply falls. Yes, one thing you should remember, during inflation, repo rate is increased. During recession, repo rate is reduced so that loans become cheap. So that loans become cheap. So that loans become cheap. Got it, everyone? Right. Please note it down. Acha, repo full form. I thought I have explained. If not, it's repurchase agreement. It's repurchased agreement. Repurchase agreement. Done? Right, sir. What is reverse repo? Reverse repo. It's interesting. Reverse repo. It is the opposite. It is the rate at which commercial banks keep their money with the RBI. Just like we people keep our money with the commercial banks. So commercial banks give us interest. What if commercial banks keep their money with the RBI? What if commercial banks keep their money with the RBI? Now what RBI does is, during inflation, RBI wants to reduce money supply with the public. RBI increases the reverse repo rate. RRR, reverse repo rate. RBI increases it. Now commercial banks feel greedy that, oh my God, if we give to the public, our interest is doubtful. We are going to get money or not is doubtful. If we give our money with the RBI, our money is safe. Our money is safe. And plus, we also get a high rate of interest risk-free. So commercial banks will feel induced to keep more money with the RBI. So commercial banks, if they keep more money with the RBI, naturally the public will have less money. So money supply falls, money supply reduces. So naturally money supply reduces. Sir, understood, sir. Sir, we have understood this. Then students, MSF, marginal standing facility. It's an interesting concept. It's a penal rate, penalty rate. It's a penalty rate. MSF is a penalty rate. Okay. So, sir, what is it exactly? It's a penalty rate imposed. Why? Because of emergency borrowings by banks. Because of what? Because of emergency borrowings by banks. Because of emergency borrowings by bank. Banks, pay attention, everyone. Banks borrow money. Banks borrow money. RBI, commercial banks. Now, sometimes they need it urgently, more than what they were allowed to. So RBI imposes a penalty. MSF rate is repo rate plus 1%. One more thing, reverse repo rate is repo minus 1%. Reverse repo rate is repo rate minus 1%. MSF rate is repo rate plus 1%. And one more thing, class, you should remember, LAF, liquidity adjustment facility. Whenever they ask you liquidity adjustment facility, students, it is repo rate plus reverse repo rate. Repo rate plus reverse repo rate. Now, what is bank rate? Students, it is the rate at which RBI lends money to commercial banks. At which RBI lends money to commercial banks. Sir, you are confusing us now. You said the same thing while teaching repo rate. But students, you know the difference. Repo rate is used for short-term lending. Repo rate is the rate of interest charged by RBI from commercial banks for the short-term loans granted by RBI to the commercial banks. But bank rate is the rate of interest used for long-term lending. Used for long-term lending. So bank rate is a long-term lending rate. Got it, sir. Now we tell you about qualitative tools. Now I tell you about qualitative tools. Students, when I say qualitative tools, I mean selective tools. Remember the name. One time institute gave this question only. Selective tools are known as what? Qualitative. Because there is an often a chance of confusion. Whether it's quantitative or qualitative, it's qualitative. Okay? Now, class. Qualitative tools are selective. Number one is regulation of margin requirements. Number one is regulation of margin requirements. What exactly is it, sir? Regulation of margin requirements. What exactly is it, sir? See carefully. You will understand. Pay attention. Suppose you people need a loan of 10 lakh rupees. Class, suppose you people need a loan of rupees 10 lakh. Okay? 10 lakh rupees. Okay? Now, when you need a 10 lakh rupee loan, you need to mortgage something. Forget about the loan amount first. Let's say you have a house worth rupees 10 lakh. If you want to take a loan, you need to mortgage the house. You need to do what? You need to mortgage the house. Class, when you mortgage the house, pay attention everybody. Now when you mortgage the house, what happens? See, you needed a loan of 10 lakhs or not of 10 lakhs, any amount. You have 10 lakh house to mortgage. Tell me something. For a 10 lakh house that you have mortgaged, bank will give you greater than 10 lakh loan, equal to 10 lakh loan, or less than 10 lakh loan. Obviously, banks are going to give you less than 10 lakhs. What if the price of the house fluctuates? Bank is not going to take that risk. So suppose you have mortgaged a property worth rupees 10 lakh. So as per RBI rules, banks will retain a margin and give you a loan of lesser amount, say 8 lakhs. So this 2 lakhs or 20% is called margin money. Is called margin money. Friends, during inflation, when the goal is to reduce money supply. Friends, during inflation, when the goal is to reduce money supply, okay? When the goal is to reduce money supply, what is done? When the goal is to reduce money supply, what is done? Simple thing. When the goal is to reduce money supply, what is done? A simple thing is done. Margin requirement is increased. So now what will happen? Initially for a 10 lakh house, you used to get a loan of 8 lakhs. Now for a 10 lakh house, you will get a loan of 6 lakh. Money supply has reduced. That was the intention during inflation. Another technique that, dear friends, is used is in qualitative techniques is moral suasion. Here basically RBI through requests, through reports, through meetings tries to convince the commercial banks to reduce their lending activities. To reduce their lending activities, RBI tries to convince commercial banks. Now, so now there was an establishment of monetary policy committee. There was an there was a establishment of monetary policy committee. It was established when? In 2016. Monetary policy committee was established when? 2016. How many members does it have? There are total how many members? 6 members. In monetary policy committee, there are how many members? 6 members. 3 are from the RBI. 3 are from the RBI and 3 are from the government. 3 members are from the RBI, 3 members are from the government. So in monetary policy committee, 3 members are from RBI and 3 members are from government. So it consists of 6 members in total. What is the objective? ये committee क्यों बैठी है? There is a committee. For what have you set up? Many functions. Particularly, they maintain the inflation target. That is, the inflation does not go beyond the lower limit or does not go above the upper limit. Inflation stays within a particular range. I will tell you that range. मैं आपको वो range बताऊंगा. This monetary policy committee also decides the repo rate. We discussed it, na? Repo rate, they decide. MPC. So the government and the RBI together take part here. Next, what is inflation targeting? What is inflation targeting? I just told you what is inflation targeting. The practice of trying to keep inflation within the tolerable limits. The practice to keep inflation within the tolerable limits. That is the lower limit and the upper limit. Both are managed. That is called inflation targeting. So here it is. This is the target of inflation, 4%, and the range has been kept as 2 to 6%. So if inflation is crossing the lower limit or above the upper limit, Then RBI must act. Then RBI takes some decisions. Some crucial decisions RBI then takes. RBI then takes some crucial decisions. Got it, sir? Conclusion. So students, the conclusion is monetary policy is powerful but complex. So a proper balance between growth and inflation is needed. Students, now let me take you to the other notes that I had made, and we can now, after that, after that, start solving MCQs. Today, I will solve MCQs with you in a different way, where I have 40 questions and every question I will not give you options. So it will not really be an MCQ. You have to say the exact answer. Okay. But here is the summary of everything we have done so far. So in savings and investment channel, let me recap it for you again. Interest rate on deposits falls. When interest rate on deposits fall, people have lesser incentive to spend, save. So because they are getting lesser interest rates. So instead they think that instead of saving, why not spend it? People spend, and when people spend, the purchase of goods and services go up. Also, fall in interest rate means loans have become cheaper. So borrowings increases, and when borrowings, investment spending increases. Result, demand also rises, output also rises. But it may increase the inflation rate because demand has increased. We have studied this, right? Then students, you have your cash flow channel. In cash flow channel, what do you have, class? If interest rate reduces, people have to pay less interest on the debts they have borrowed. People have to pay less interest on the debts they have borrowed. So they have more cash available. Since they have more cash available, they can spend more on goods and services. Net result, their spending increases. Net result, their spending increases. Asset price and wealth channel. Class, when interest rate falls, when interest rate falls, demand for loans, housing loans increases. So asset prices will increase. People are buying more, people are taking more loans. So naturally, the asset prices are going to increase. People who are already having assets, huh? Their wealth increases. Their wealth increases. Their ability to borrow increases. Their consumption and investment increases. Result, more output. Again, impact may be inflation rising. We have studied that. Finally, exchange rate. If interest rate falls, no, investors are not willing to invest in India anymore. So the demand for rupee falls. Exports increase, imports become costly. Then we talk about the different rates. Cash reserve ratio are percentage of net total deposits that banks must keep with RBI. That, and they will not get interest on this. They just have to keep SLR that the banks can keep with themselves. Very low interest. It can be in cash, gold, and securities. Open market operations. Acha, remember, quantitative techniques affect the money supply in entire economy. Qualitative techniques affect the specific sector. That's why qualitative were called selective. Quantitative affects the entire economy. Open market operations, you all know it, selling or buying government securities in the open market. And then there is market stabilization scheme, MSS. What is MSS? Market stabilization scheme. What is this MSS, sir? Here government borrows from RBI over and above the normal borrowing. Government is borrowing over and above the normal borrowing. Class, government is borrowing over and above the normal borrowing and issues this securities in the market to control liquidity and issues this security in the market to control liquidity. Government borrows from RBI over and above the normal borrowing and issues securities in the market to control liquidity. Next, qualitative techniques. Number one was margin requirements. Here what happens? RBI prescribes margin against collateral to control borrowing. So a margin is prescribed, moral suasion requests, and then there is credit rationing, regulation of consumer credit, etc. Other tools. Some important rates: bank rate, rate at which RBI lends long-term funds to banks. This is prescribed. See, commercial banks need funds for long term only when they are not able to use the short term funds efficiently. So it is like a penalty rate because they were unable to maintain the SLR or CRR. When banks are unable to maintain SLR or CRR, RBI helps them and prescribes a higher penalty rate. That is called bank rate. So in reality, bank rate is meant to be a penalty rate. Repo rate, rate at which banks borrow from RBI for short term. Reverse repo, it is repo rate minus 1%. It is the rate at which commercial banks can deposit their excess money with the RBI. And MSM, marginal standing facility. It is the penal rate at which RBI lends to bank overnight over and above repo rate. Understood? Right, sir. Then the MPC, Monetary Policy Committee. So RBI Act 1934 was changed in 2016 for MPC. So it determines the policy rate to achieve inflation target through debate and majority vote. So there is a debate that goes on here. So class, there is a debate that goes on here and majority vote. There are how many people? 6 members. Who are they? The RBI governor, the deputy governor of RBI, some other RBI officer, and then experts appointed by government 3. So total how many people? 6. Finally, you have MPFA, Monetary Policy Framework Agreement. Full form can come in the exam. So students, one must note it down. MPFA, Monetary Policy Framework Agreement. So I will explain you this. What happens here is, it is an agreement between Government of India and RBI. It is an agreement between who and who? Between the Government of India and the RBI. Where inflation target is kept between 2 to 6% and target is reviewed after every 5 years. If your average inflation is upper tolerance limit for 3 consecutive quarters, that is for consecutive 9 months, it is called failure. Or your average inflation is lower than lower tolerance, that is 2% for 3 consecutive quarters, then it will be regarded as failure. And when failure, RBI has to do something, take some action. Sir, got it. Sir, got it. Now, class, just a moment, everyone. We are going to practice some MCQs. Not exactly MCQs, but directly. Students, the first question is, what is the function of money policy? You can write it, okay, one by one. You can say, name the following type of questions I have prepared, okay? What is the function of monetary policy? Remember class, the answer is to regulate the availability, cost and use of money and credit. You should write it down like this. Function of monetary policy to regulate the availability, cost and use of money and credit. To regulate the availability, cost and use of money and credit. Question is given, you think of the answer. Now, what is the main objective of monetary policy? Have we not discussed it hundreds of times? What is the main objective of monetary policy? Economic growth with with price stability. Economic growth with price stability. Now, what is monetary policy transmission mechanism? Class, what is monetary policy transmission mechanism? All of you know this. It is a process through which monetary aggregates affect the output and the prices. So any action of the government affects the output and the prices. Process through which monetary aggregates affects the output and the prices. So now, if there is a contractionary policy and because of that, there is increase in interest rate. Increase in interest rate means increase in cost of capital and borrowings for firms and the households. So the borrowings for the firms and the households become more expensive. What does RBI do during deflation? RBI during deflation reduces CRR. Reduces CRR. Now, let me give you questions from the back. ICAI questions. Let's solve them a bit. I have another set of questions ready. We will do that. First, this one class. Okay. So, the first question. I am sure majority of students will answer this. Yes. So, which of the following is function of monetary policy? Regulate the availability, cost and use of money and credit. We discussed it just now. We discussed it just now. Yes or no class? Next one is main objective of monetary policy in India. So class, what is the main objective of monetary policy in India? Economic growth with price stability. Next, monetary policy transmission mechanism refers to what? Think carefully. You are right, class. It is the process or channel through which evolution of monetary aggregates affects the level of products and prices, right? Okay. A contractionary monetary policy induced increase in interest rates. So if interest rate increases, what happens? It increases the cost of capital and the real cost of borrowing for firms and households. It increases the cost of capital and the real cost of borrowing for firms and households. Understood, sir? Next one is during deflation, what happens? Think carefully and answer, class. See, RBI reduces the CRR in order to enable the banks to expand credit and increase the supply of money available in the economy. Correct. Deflation means reduce the rate. Inflation means increase the rate. Which of the following is correct? Think carefully and answer, class. Which of the following is correct? See, Governor of RBI in consultation with finance decides the policy rate. No, it is the Monetary Policy Committee, which doesn't only have governor. They have deputy governor, one other person from RBI. It's 3 plus 3. 6B. While CRR has to be maintained by banks as cash with RBI, SLR requires holding of approved by the bank itself. Huh? It's okay. Correct. Hai. Number 7. If you have noted it down, class, you will know the answer. If you were maintaining running notes, you will know the answer. RBI provides financial accommodation to commercial bank through repo rates and reverse repo rates. Under, we have discussed it today only, LAF. We have discussed it. LAF is liquidity adjustment facility. Repo plus reverse repo both come under LAF, liquidity adjustment facility. Repo and reverse repo both come under liquidity adjustment facility. Number 8. DES is a money market instrument which enables collateralized short-term borrowing and lending through sale purchase operate in debt instruments. Collateralized short-term borrowing and lending. So when they are saying short-term, OMO, CRR, SLR is not short-term. Only repo rate is short-term. Short-term borrowing and lending. So only repo is short-term out of the 4. In India, what is policy rate? Very important question. So class, it is the fixed repo rate quoted for sovereign securities in the overnight segment of the liquidity adjustment facility. Yes. So it is the fixed repo rate quoted for sovereign securities. Sovereign means government securities in the overnight segment of the LAF. Overnight segment means for the short-term borrowings. Okay. Now, so policy rate is the repo rate. Whenever we refer to policy rate, it's the repo rate. 10th, reverse repo. Operation takes place when? When does reverse repo operation take place? So students, see carefully and think. Reverse repo operations take place when, class, RBI borrows money from banks by giving them securities. When RBI borrows money from banks by giving them securities. That is reverse repo operation. RBI borrows money from banks by giving them securities. 11th, what is monetary policy framework agreement? Maximum repo rate that RBI can charge, maximum tolerable inflation rate that RBI should target to achieve price stability. Yes. Monetary policy framework agreement. Maximum tolerable inflation rate RBI should target to achieve. Yes, because this policy framework agreement was mainly set up to achieve the inflation target. So they are correct. Moving on. Number 12 class. An open market operation is an instrument of monetary policy which involves buying or selling of dash from or to the public and banks. Which involve buying or selling of what? Government securities. Yes, that's correct. Buying or selling of government securities from or to the public and banks. Which statement is true about monetary policy committee? Let's see. RBI Act was amended for giving a statutory backing to framework agreement, है ना? And for setting up a monetary policy committee. Pay attention. This is okay. It is all right. This statement is perfect. Next, monetary policy committee shall determine the policy rate through debate and majority vote by a panel of experts to achieve the inflation targets. Correct. Monetary policy shall determine the policy rate through consensus. No, through debate and majority vote. So there will be debate among the government officials and the RBI officials to decide this. By a panel of bankers. No. So 1 and 2 are correct. Only 1 and 2 are correct, class. Hold on. Some more MCQs awaits. हाँ. Question number 4, class. Think and then answer. Which tool is used to absorb liquidity by RBI? To absorb liquidity by RBI. Which tool is used to absorb liquidity by the RBI? A good question. Students, the question options are reverse repo, repo, bank rate. ये. Absorb liquidity means to reduce money supply. Now, students, it is reverse repo rate. See, these three are of same types. Reverse repo is to absorb liquidity. By RBI means RBI takes the money of commercial banks. Yes or no? Absorb liquidity means RBI is taking back the money. How does RBI take the money? By reverse repo, because they force commercial banks to deposit the money with them. CRR is maintained in gold, government securities, cash with RBI, and loans. CRR maintained in what form? See, CRR has to be maintained in the form of cash. There is no, second answer that you can possibly give here. CRR has to be maintained in the form of cash. Which of the following is a qualitative instrument of monetary policy? Qualitative. C. Everybody, regulation of margin requirement is the correct answer. Regulation of margin requirement is the correct answer. Class, we have discussed it today 2 times, 3 times. It's very shameful if you will not be able to answer this now. It will really be shameful, class. LAF includes what? Students, the correct answer is apparently repo and reverse repo rate. repo rate and reverse repo rate. See, this is from the earlier unit, but it can be asked again here also. If CRR is 10%, then multiplier is, you all know it, credit multiplier is 1 by CRR. Credit multiplier is 1 by CRR. So my dear students, 1 by 10%, 100 by 10, 10 times is the correct answer. Next, the Monetary Policy Committee sets what? The Monetary Policy Committee sets what? SLR, CRR, repo, or bank? Yes, Monetary Policy Committee sets repo rate. Yes, in fact, if you all have noticed in the functions of Monetary Policy Committee, I have made you all right. First function was setting of repo rate. Right? Understood, sir. Huh. Increase in interest rate usually leads to what? Increase in interest rate usually leads to what? So class C here. Increase in interest rate usually leads to increase in consumption, decrease in investment, increase in borrowing, increase in demand for housing. Correct answer is decrease in investment. Because when interest rate increases on loans, people will borrow less. When they borrow less, their investment gradually declines. Okay. Money supply, we have discussed it already. Monetary policy into base money. Good question. Which component of money supply is not influenced by RBI directly? Yes, where RBI cannot interfere, I should say. Public's cash holding is the correct answer. Public's cash holding seems to be correct. When RBI buys securities in the open market, what happens to liquidity? Increases, decreases, inflation falls, CRR increases. What happens? When RBI buys securities in open market, so class, when RBI is buying security in the open market, RBI is buying. It means RBI is giving money. So the liquidity increases. People are getting more money in their hands. Come on. People are getting more money in their hands. So therefore sir, liquidity increases. MSF is always 0.5%, 2%, 1%, 1% below. I have given you the formula of MSF today only. 100%. MSF rate is repo plus 1. Repo plus 1. So 1% above repo rate. Next, CPI inflation target under the current framework is 2 to 6%. 4% is the average. What is the main objective of monetary policy in India? Full employment, exchange rate stability, price stability with growth, control of imports. What is the main objective? Obviously, sir, you have spoken hundreds of times. Price stability with growth. Which of the following increases money supply class? I will explain it now. Which of the following increases money supply? Increase in CRR, sale of government by RBI, securities by RBI. So now pay attention. If you increase CRR, money supply will reduce. Sale of government securities by RBI, money supply will reduce. But yes, purchase of government securities by RBI is going to infuse liquidity into the market. If there is a high multiplier, what are the consequences? High inflation risk, tight liquidity, increase in SLR, decline in GDP. Think of this, you will be able to answer. So class, it's a very simple thing. High money multiplier means that for every 1 rupee you invest in the economy, it will become, let's say, rupees 50 in the form of loans and all. Yes. So if there is high money multiplication, many people are having money. So what will it lead to? It might lead to high inflation risk because many people have money. This we had already done. Acha students, when I was teaching qualitative techniques of credit control, when I was teaching qualitative techniques of credit control, two things stood out in particular. I mean, 2 points stood out in particular in the qualitative techniques of credit control. What are the 2 points, sir? Selective credit control. We have not discussed it in details. I had kept it for the last. Selective credit control. What are the 2 points? One is credit rationing. Credit rationing. Next is regulation of consumer credit. Regulation of consumer credit. Credit rationing and regulation of consumer credit. Now let me explain it to you, class. Think carefully. Think carefully, everybody. Credit rationing and regulation of consumer credit. Pay attention, class. Whenever you are ready. Ready? Here we go. Number one thing. Number one thing. What is the number one thing? Credit rationing. Students, in credit rationing, government basically or RBI basically sets up the maximum limit. You can write it down. Setting of maximum limit. Setting of maximum limit by the RBI. So basically, RBI sets the maximum amount for each commercial bank. Let's say this is commercial bank A, commercial bank B, commercial bank C, commercial bank D. So commercial bank A, RBI is told that to the agricultural sector, you will give not loans not more than 10 crores. To bank B, similar instructions C, D, or different instructions to each bank. That is credit rationing. That is to keep the maximum limit, set the ceiling limit. RBI is setting up the ceiling limit for each of them. RBI is setting the ceiling limit for each of them. Understood? Right, sir. So a basic ceiling limit is set up. Now, this is done. Next point is, what is it, sir? Credit rationing is done. Fourth point is where we talk about class. Fourth point is where we talk about regulation of consumer credit, RECC. What does it mean, sir? Regulation of consumer credit can be done in two ways. Either RBI can reduce the installments, reduce the number of installments. I am talking about inflation. Reduce the number of installments or increase the down payment. Let me explain it through an example. You will understand. In regulation of consumer credit, either of the two will take place, class. How so? I will explain now. First, you read written now. I am explaining for the action during inflation. Huh? During inflation, what action will be taken? I am explaining that. Okay. So class, let's suppose there is an inflation in the economy. Okay. Now, friends, when there is inflation that the economy is witnessing, how will the RBI act? I am answering that. I gave you the example of television. I had purchased TV worth rupees 20,000. Okay. Now, see the action of RBI. Just a minute. Here it goes. What RBI can do is, suppose this 20,000 TV was divided into 10 months. So the consumer could pay 2,000 per month. So the consumer could pay 2,000 per month. Now what the RBI can do is, they can change the dynamics. What RBI can do is, now 2,000 per month, instead RBI can say, no, if you want to buy a TV out of 20,000, you do not pay in 10 months. RBI wants to reduce money. RBI wants lesser people to buy. Okay, pay it in 4 months only. Make things difficult for the people. That's it. Make things difficult for the people. So now the person has to pay 5,000 per month. Imagine, for a person who is not from such a good background, 5,000 per month is a huge amount. That is their entire month's ration. That is their entire month's ration. Got it? Now, class, now. This is one thing. Another thing could be, another thing could be, again, same thing. Regulation of consumer credit. TV is worth rupees 20,000. RBI makes it a rule that 40% consumers have to pay upfront. That is called DP, down payment. So 8,000 down payment you pay, and remaining 12,000 you can convert it into EMIs. Again, making things difficult. Again, making things difficult. Again, making things difficult. 20,000 minus 8,000, that is 12,000. Got it or not got it? Right, sir, got it. So we have understood this, sir. Now you tell me something, class. If you all have understood, some full forms I will ask, because that definitely comes in the examination. Okay. So MSS, simple question. What is MSS? I'm asking only from today's class, not from earlier class. So it is, students, you guessed it correct. Market stabilization scheme. Market stabilization scheme. MSS is market stabilization scheme. What is the full form of repo? What is the full form of repo? Class, it's repurchase agreement. Repurchase agreement overnight. Okay. Now, what is the full form of, class? LAF. Everybody, what is the full form of LAF? Liquidity adjustment facility. I hope all of you are taking running notes, class. Liquidity adjustment facility. Right, sir, right. Class, what is the full form of MPC? What is the full form, my dear students, of MPC? You all are correct. Students, it is monetary policy committee. It is monetary policy committee. Monetary policy committee. Then MPFA. What is MPFA, class? Students, MPFA stands for monetary policy framework agreement. What is MSF, class? Students, what is MSF? Because this chapter happens to have a lot of full forms, one might get confused, and that's the reason I'm, doing it in word by word, so that everybody gets a note of them in their copies. MSF. Class, everybody, MSF stands for marginal standing facility. Marginal standing facility. Students, an MCQ that I am just reminded of. Can you tell me what is that rate called, which is a penal rate that RBI imposes on commercial bank because of commercial banks failure to maintain because of commercial banks to maintain CRR or SLR? Penal rate that the RBI imposes on failure to maintain CRR and SLR. Can you tell me the name of that penal rate, dear students? I am waiting. That penal rate that RBI imposes on failure to maintain CRR and SLR. Think and then answer, class. Oftentimes, students make this mistake. So, students, the answer is very simple. The name is PC. The penalty rate that RBI imposes on failure to maintain CRR and SLR, students, that penalty rate is called, you guessed it correctly, class, bank rate. Okay, one more thing, class, what is the policy rate? Whose rate is the policy rate? Whose rate? There are different rates you have studied. Bank, repo, reverse repo, CRR, SLR. So many things you have studied. Whose rate is the policy rate? We have done it today. I have discussed it in MCQs. In the ICAI material, this MCQ was there. You have solved it. Let's see. I can show you the question also. I'll show it after answering. Students, policy rate is the repo rate that is quoted in the overnight segment of the liquidity adjustment facility for government securities, that is sovereign securities. For government securities, that is sovereign securities. Yes or no? So policy rate is nothing but the repo rate. And which is the commonly used rate? Repo rate. Remember, bank rate is not the common rate. It is the penalty rate. So often the rate used is repo rate as a reference point for anything. You see, MSF is repo plus 1. Reverse repo is repo minus 1. So all the rates have been defined according to who? The repo. It is the base rate. If you did not get it, you are absolutely going wrong. It is the base rate. It forms the basis for everything else. Understood, class? So remember this. And yes, as far as showing you whether it was there and whether we have discussed it, I can do that. Here it is, question number 9. We discussed it now. The term policy rate refers to fixed repo rate quoted for sovereign securities in the overnight segment of the liquidity adjustment facility. Sovereign means government securities. I told you. Overnight segment means basically for short-term loans. Overnight segment is nothing but for short-term loans. Understood? And do not forget it, class. MSF rate is repo plus 1. MSF rate is repo plus 1 and reverse repo rate is repo rate minus 1. MSF rate is repo plus 1 and reverse repo rate is repo minus 1. With this, students, we can wind up the day. See you all in the next class. Goodbye, everyone, with a new chapter. Tech support, we can wind up.